Welcome to ING's Think Aloud, where we try to make sense of the world in the most unbanky way we can. In today's episode,
it seems that almost every day we reach a new and grim record. Some countries are continuing to see a rapid increase in cases and deaths. Some countries that have successfully suppressed transmission are now seeing an upswing in cases as they reopen their societies and economies.
the World Health Organization's Director General says more than 9 million cases of Covid19 have been reported to the WHO so far, with 4 million of those occurring in the last month alone. And yet, financial markets have been calm. The S&P 500 is on track for one of its best quarters on record. The Nasdaq hit an all-time high this week, and the safe haven dollar has been selling off. But as recently reopened US states battle to contain the virus and fresh outbreaks occur in Germany and China, is confidence starting to falter? I'm Rebecca Byrne, and today I'm joined by Chris Turner, ING's Global Head of Markets, to find out. Chris, risk assets have been gaining momentum pretty much since mid-March, but the virus has not been suppressed. We're still seeing cases go up in the US. There have been some other clusters in places in Europe, Asia, Latin America. Has the market got ahead of itself?
I think it's hard to say that. And I think really because you've got to look at the context here, which is really that there's a lot of pressure to perform for investors and like for the buy side managing money. We're talking about this thing called the TINA principle. There is no alternative to investing in equity markets. And I think certainly the central banks, with their aggressive policy actions of pumping liquidity into the economy, they want to drive investors down the credit curve. They don't really want people to be holding money just in short-term safe haven deposits. They want to drive them down the credit curves and into financial assets. So that is really the objective this year, to restore confidence. Seems to be working so far. Invariably, there will be setbacks along the way as cases kick up. But I think that will be the trend for this year, which will be abundant liquidity and probably financial assets being supported on dips.
Okay, but White House advisor Peter Navarro spooked the markets this week after he said that the US-China trade deal is over. Now, the White House has obviously come out and denied this, but there's still a lot of uncertainty about the future of trade relations. Is that something that could keep global markets on the back foot and therefore maybe help the dollar?
Yes, that's definitely the case. And if you look back in 2018 to 2019 and try to make sense of the 10% rally in the dollar during that period, it really was the 1-2 combination of the tailwind of that large $1 trillion US tax cut driving the US economy forward, providing the tailwind and providing Donald Trump and his administration with the opportunity to really smash trading partners, really starting the trade war with China started about March 2018. So there is that risk. The market is certainly worried about that for the rest of this year. I think perhaps going forward, fiscal policy is a differentiating factor. It's probably different now. I think everyone's using fiscal, but certainly and I think it would be a surprise to the market right now, because we and the market probably think that it's a bit too dangerous for Donald Trump to be really turning aggressive on trade to damage the equity markets so close to the November presidential elections.
Right, well, that election is only about 5 months away. How significant is that event for the US currency?
To be honest, it hasn't felt like elections are really driving the FX markets, but invariably it will do as the summer progresses. So I think the narrative of the election is falling along the following lines. In terms of Donald Trump, you know what you're going to get. You're going to get, where possible, you're going to get some fiscal stimulus, you're going to get loose regulation, and you're probably going to get aggressive trade policy. When it comes to Joe Biden, the view is you're going to get probably more redistributive tax moves, so less loose fiscal policy. You're probably going to get more regulation, perhaps a less business-friendly environment, but at the same time, less aggressive on trade, which overall will be a dollar negative. So I think at the moment, the narrative is seen as Trump as a dollar positive, Biden a dollar negative. As we often find in FX markets, narratives can quickly switch, but I think that will probably be the story as we run into November.
Yeah. Now, the Yale economist Stephen Roach recently said that the dollar is going to fall very sharply, and he predicted that the era of the dollar as the world's reserve currency is coming to an end, largely because of the huge US deficits. What's your take on this?
Well, to be honest, I think you need to have a more imaginative case for a dollar collapse than twin deficits. I mean, we've been looking at those over the last sort of 20 plus years or so. Obviously, wider deficits mean you need to rely more on the kindness of strangers, but the dollar historically has withstood the twin deficit story pretty well. And actually, we haven't had a negative story backed by a negative US narrative since the early 2000s. Personally, I think the end of the dollar's reserve status will take more time. We need to see much greater competition to the dollar in terms of its use in supply chains and international financing. In fact, there was a recent BIS report that showed around half of all cross-border loans and half of international debt securities are still denominated in dollars, even if the US only makes up about a quarter of the global economy. Now, the challenge to the dollar offered by the euro and renminbi, that has certainly been slow in coming.
Well, let's talk about the euro. The ECB has obviously been throwing everything at the crisis, and leaders are now in talks about possible debt sharing. How significant is that for the euro, and what's your view for the rest of the year?
Yeah, I think that's been a really, really important story for the euro. I mean, during the start of this crisis, we were looking back at what happened during 2008, 2009 with the Eurozone debt crisis that built between 2010 and 2012. And the idea was, I suppose, in March and April that, you know what, Europe is going to hold the global recovery back because we're going to just make loans to Italy, a debt will pile up and will just effectively result in another Eurozone debt crisis. But what we've seen over the last 4 to 6 weeks has been, I think, really, a kind of huge turnaround in sentiment for Europe. The EU Recovery Fund, the large stimulus, the concept of the large German stimulus, the concept of financial burden sharing, I think has been very positive. And the fact that Europe can contribute to the global recovery, assuming the EU Recovery Fund moves in the right direction, I think is very supportive for commodity currencies, but also for the euro. So at the moment, we forecast euro dollar heading up towards 120 by the end of this year, but that very much relies on continued progress in terms of this EU Recovery Fund.
Right. Well, EU leaders have also been in talks with the UK recently to try to break the impasse on Brexit. And it seems as though sentiment might be shifting a little bit with more willingness on both sides to compromise. What's your position on sterling?
Yep, sterling is very tricky. Again, these narrative flips very quickly. We're a little bearish, we're generally bearish on sterling against the euro, just over the next sort of 3 to 6 months or so. But we are backing the weaker dollar story to drag cable, and that's sterling against the dollar, up to the 135 area for year end. And that's, I think, a little higher than consensus. I mean, a couple of months ago, we had sterling against dollar falling to 115. That was all about dollar liquidity drying up and the dollar going through the roof. And that environment has certainly changed. In terms of Brexit, our ING house view, you've heard from James Smith here, is that we're going to probably see a free trade deal reached by October, and we probably think euro sterling will end the year around the 90 level.
Chris, when you look at the FX markets globally, which do you think are likely to lead as economies reopen? Which factors are you looking at, and which currencies do you consider to be the most undervalued right now?
Well, yeah, Google mobility data has been a very popular tool to look at how quickly economies are bouncing back and reopening, where they stand relative to pre-crisis levels. And on that measure, actually, Norway stands out pretty positively. And also, you're asking about undervalued currencies. We think the Norwegian krone is still undervalued. So that might be a currency that continues to do well if we're focusing on the reopening story. Also, Korea has won a lot of plaudits for its handling of the COVID crisis. The Korean won has lagged the recovery in risk currencies, but is undervalued and could play catch up if external conditions allow. At the other end of the spectrum sits the UK, which you mentioned before. So sterling shouldn't outperform based on Google mobility data. But we also see like a country like Mexico, and I know that our LATAM economist Gustavo Rangel, he's worried by Mexico's relatively small fiscal stimulus so far.
Well, you mentioned the Norwegian krone there. Oil prices have obviously made quite a dramatic recovery since late April when they went into negative territory. Have commodity currencies reflected this move? And what's the outlook for them now?
Yeah, we touched on Norway earlier, and certainly if oil prices do head higher, and Warren Patterson, our commodity strategist, does think that Brent's probably going to be pushing up to the 60 area in the second half of the year, so it should provide a supportive environment. So Norway, as we said, should continue to perform well. The Russian ruble has already done well, but we're looking at the balance of payments situations and the changes they're making over there to the budget rule, and we prefer a story of it's holding its gains rather than pushing ahead much further. Of the rest, we quite like the Canadian dollar, actually. The speculative trading community is surprisingly still quite short Canadian dollars at the moment. We forecast a 5% appreciation against the US dollar by the end of the year. And if we do see a benign decline in the US dollar, which is our call for the second half, I think the Canadian dollar should certainly participate in that.
Okay, Chris Turner, ING's Global Head of Markets and Regional Head of Research for the UK and Central and Eastern Europe. Thank you very much.
Thanks, Rebecca.
This podcast has been prepared by ING solely for information purposes, irrespective of a particular user's means, financial situation, or investment objective. The information does not constitute investment recommendation, and nor is it investment, legal, or tax advice, or an offer or solicitation to purchase or sell any financial instrument. Read more at think.ing.com/content-disclaimer.